If you're nearing retirement and worried you haven't saved enough, you're certainly not alone. It's a common concern that keeps many Americans up at night. But here's something important to understand. A successful retirement isn't just about the sheer size of your savings account. It's more about how efficiently your money can work for you once your regular paychecks stop. Even a modest nest egg can support a comfortable and meaningful retirement when the strategy behind it is strong and well planned. So today, we're going to explore practical strategies and smart financial approaches that can help you retire with confidence, even if your savings feel smaller than you've originally hoped. Because before you can build a solid retirement plan, you need a clear vision of what you want your future to look like. So before we get into the nitty-gritty of investments and income strategies, let's take a moment to figure out what retirement means to you. This is about more than just money. It's about your life. So let's start by asking a couple questions. What does a comfortable retirement look like? Do you see yourself traveling the world, spending more time with family, or finally pursuing a hobby that you've always dreamed of? Think about how much money you'll realistically need each month to live that life without financial stress. And don't forget to factor in everything: daily expenses to healthcare, and also the travel you want to do. Where will your income come from? Will it be savings, investments, a pension if you have one, or maybe even part-time work? Because your retirement goal isn't just a number, it's a blueprint for a whole new chapter of life. It's about the lifestyle you want, the freedom you crave, and the memories you want to make with the people you love. Because once you have a clear picture of your ideal retirement, it's much easier to build a financial plan to help get you there. And a clear goal gives your plan purpose and makes the journey feel more straightforward and meaningful. Because retirement success is not defined by how much you have saved over time. It's actually defined by how well your plan supports the life you want to live. And the clarity around your goals helps guide every decision that's going to follow. So let's get real for a moment about something that might shock you, especially if you're planning for the future. The typical American between age 55 and 64 only has about $120,000 saved for retirement. Now, if that sounds low, you're actually right. It's way below the $1 million to $2 million mark that financial experts often suggest you're going to need in retirement to live comfortably. So why is there such a big gap? Well, life happens. Many of us start saving late because of student loans or family expenses, and unexpected things like medical bills, job loss, or caring for both kids and your aging parents can wipe out savings. Plus, people are also living longer these days, which means retirement can last longer than we've ever thought. But here's what I really want you to take away from this. A comfortable retirement isn't about hitting some huge savings number you see on the news. It's about creating a smart income plan that actually fits the life you want to live. Even if your savings aren't massive, you can turn them into steady income streams by coordinating them with other resources. This means making the most of your Social Security, maybe working part-time or looking into things like fixed indexed annuities, and using smart withdrawal strategies to make your money last over the course of your retirement. Because when savings are limited, careful planning becomes paramount. Retirees with smaller nest eggs face three major challenges that require thoughtful consideration. First, inflation. It can erode purchasing power over time. And if your retirement income doesn't keep pace with the rising costs, managing everyday expenses like housing, groceries, and healthcare will become increasingly difficult. And to counter this, a portion of your portfolio should remain positioned for growth, even in retirement. Secondly, longevity risk. With many people spending 25 to 30 years in retirement, the blessing of a long life also brings the risk of outliving your savings. So creating a stable, Financial foundation through reliable income sources like Social Security, pensions, or income producing annuities can help ensure your resources last a lifetime. And finally, the last challenge, a smaller nest egg offers limited flexibility. There is less margin for unexpected expenses, which makes coordinating planning for healthcare costs, tax efficient strategies, and spending priorities all the more critical. So when savings are limited, every dollar counts, which makes having a clear strategy even more important. It's not just about what you save, but how you actually manage it, how you nurture it, and how, you guessed it, you grow it. Because the right plan can help you prioritize your financial goals, identify opportunities, and stretch your resources much further than you might expect, turning even a small amount into a powerful tool for your future. So let's explore some strategies that can strengthen your retirement even with a smaller savings base. So for many retirees, Social Security is one of the most valuable income sources. So delaying your benefits until age 70 can significantly increase your monthly payments, sometimes by as much as 30%. So when savings are limited, maybe it pays to wait a little bit longer for your Social Security and also work a little longer too. Now, if you have a pension or annuity, carefully reviewing your payout options can enhance your long-term income stability. Or just work part-time during retirement. It can extend your savings while providing structure and social connection. Many retirees find that consultant or part-time work gives their investments more time to grow. And it's never talked about enough, downsizing your home or relocating to a lower cost area can reduce your housing expenses and free up even more cash flow. So a smaller home often translates to lower maintenance costs, reduced property taxes, and greater long-term financial flexibility. And now, it's not often talked about enough, but healthcare, it's one of the largest expenses in retirement. And understanding your Medicare options, your supplemental insurance, and potential long-term care needs is essential for preventing financial surprises down the road. Coordinating withdrawals between traditional IRAs, Roth IRAs, and your 401k accounts can minimize your tax burden and make your income last even longer. Additionally, strategic Roth conversions during lower income years may often create greater tax flexibility later in your retirement. Now, a smaller nest egg does not mean a smaller retirement. It simply means your strategy needs to be smarter. It needs to be fastidious. And with the right plan, modest savings can still support a fulfilling lifestyle. Now, a common mistake retirees make is playing it too safe with their investments right after they stop working. It's natural to want to protect what you saved, but moving all your money into cash or super low risk options like savings account can actually be a big financial blunder. Now, why do you ask? While these choices seem safe, they have a secret enemy, inflation. And as time goes up, the cost of living goes down. The value of your money also goes down too. This means your savings won't cover as much as you thought they would. So what's the solution? Many financial advisors suggest a bucket strategy. Think of it as organizing your retirement into 3 different layers: short-term funds or your non-at-risk assets. The first bucket should hold cash to cover your living expenses for anywhere from 6 months to 2 years, depending on your risk tolerance. Now, keeping this money easily accessible, low-risk places like cash accounts, money market funds, or short-term CDs will benefit you so you don't have to sell when the markets go down. Now, secondly, the second bucket is your midterm investments. It's for your needs over time, over the next 3 to 10 years. This part of your portfolio should aim for a balance of stability and moderate growth. Think of high-quality bonds mixed with some reliable blue-chip stocks and ETFs. And the last bucket, your long-term growth investments. Your final bucket is about growing your money over the long haul to beat inflation and make sure you don't run out. This is where you can have a mix of different stocks, both from US and internationally, and other assets that are geared for growth. Now, by using this layered approach, you can cover your immediate needs with your short-term bucket while the rest of your money continues to grow. Securing your financial future. And when your savings are modest, every financial decision carries more weight. Juggling the timing of Social Security benefits, investment withdrawals, tax strategies, and healthcare costs can be quite complex. This is where guidance comes in. It's where it's actually invaluable. At Retirement Capital, our 5 freedoms approach integrates income planning, your investment strategy, tax strategies, preparing for unreimbursed medical costs and healthcare, and then last but certainly not least, creating a legacy into a single comprehensive plan. We help our clients replace uncertainty with clarity, enabling them to live comfortably and confidently in retirement. They're ready for a retirement that's fulfilling, not just funded. It's not about having the biggest bank account, it's about having the smartest strategy in place. So imagine a time where your savings, income, and dreams all work together. With clear goals, consistent habits, and the right advice, you can turn any nest egg into a source of empowerment. Now, retirement isn't about limits, it's about liberation. And if you found this helpful, subscribe for more retirement education. And if you would like help building a retirement strategy designed around your goals and resources, book a connection conversation today on Zoom or in our offices, and we're happy to see how we can help you experience more life with fewer limits.